All right, so I'm Grace, and along with Jack, Matt, and James, we are doing a financial profile on Churchill Downs Incorporated. So, Churchill Downs Incorporated is a racing, online wagering, and gaming entertainment company, most notably known for its Churchill Downs racing property, which is the home of the famous Kentucky Derby. The company started as one racetrack in Louisville, Kentucky, and has evolved into a publicly traded company with a wide portfolio, including racetracks, casinos, and online wagering, along with many subsidiaries. And to start with the financial statements, we have James, the income statement.
Yes, for the income statement, we go through revenue, expenses, and net income. So starting out with revenue, we have increased revenue every year besides 2020. Currently, we are sitting at 1.8 million at the end of 2022. Gross profit, we are now at $566,000 at the end of 2022, which has also gone up every year besides 2020. The only thing that really hasn't gone up this year is our net profits. Our net profit margins so far this year are lower than 2022. That is something that we hope to fix. But then we'll get into total expenses. Total expenses has increased each year as well, but we're putting a lot more money in the company. So we basically are going to have some more expenses when you're getting a lot more revenue. And then we now have our net income of $439,000 at the end of 2022 with continued operations. What I take away from this income statement is, as an industry, we are very susceptible to a shutdown. We kind of hit like a really rough patch during that shutdown, and if it were to happen again, it would also look like that again probably. But we have recovered since then, and we hope to keep moving forward as a company. And with our balance sheet, I will send it over to Grace.
Thanks. So, a balance sheet really shows the information about a company's resources and then their sources of capital with between their assets and their liabilities. And a balance sheet really helps you answer the questions: can the company meet future debt obligations, and can they pay for their long-term operating needs? So at Churchill Downs, the total debt has increased significantly since 2021. We had a jump from 1.9 billion to 4.6 billion. And with that jump, it has become evident that Churchill Downs short-term assets of 583.2 million does not cover its short or long-term liabilities, with the long-term liabilities being 5.1 billion. Our total shareholder equity of is 500 is eight sorry $853.8 million, and with that total debt of 4.6 billion, it brings our debt to equity ratio to 541%, which is extremely high. And in addition to all of this, our interest payments on debts are not well covered by our earnings before interest and taxes, with there only being a 2.3 times coverage. Our next financial statement will be our cash flows with Jack.
How's it going? Cash flows demonstrates data regarding the cash inflows that a company receives. Includes cash made by business through various factors. The first thing we're going to be looking at is our current return on investment, which is 41.78%. This is very good, but the metric is skewed because of Churchill Downs' high level of debt. A higher return on investment demonstrates how effectively a company uses shareholder equity to generate income. So this is good. Debt is not well covered by operating cash flow, with the cash flow to debt ratio being 12.1%. This compares the company's generated cash flow from operations to its total debt. So it's not great right now, but we're expecting it to improve in the future. Currently at a negative free cash flow, which means that after covering operating capital and non-cash expenses, there's no cash left over. Very low. There's also a very low dividend yield, with it only being at 0.33%, which isn't great, but it's expected to grow in coming years as we generate more revenue. Next, we're going to be headed over to the financial ratios, which are useful information about a company. They measure profitability, efficiency, as long as other metrics. Churchill Downs current/quick ratio is 55.4%. This shows that if necessary, Churchill Downs would be able to liquidate 55.4% of its assets into cash quickly. The cash ratio is currently at 32.9%. This is the percentage of a company's current liabilities that can be covered by cash and cash equivalents on hand. So only 32.9% of all debt could be covered by cash and cash equivalents at this time. Both of these ratios are from 2022 and are down from 2021, but are expected to grow in future years as Churchill Downs continues operations. Now I'm going to throw it over to Matt, who will be sharing competitor information with us.
Thank you, Jack. When looking at competitors, we decided to compare Churchill Downs to Boyd Gaming and Caesars Entertainment. The reason that we chose these two companies is because not only are they both in the hospitality industry, but they also both share similar sources of revenue with Churchill Downs. All three of these companies make a significant amount of their revenue from the gaming section, which includes things like slot machines, table games, and other casino activities. They both also share a large portion of revenue from entertainment. Churchill Downs is known for hosting our live horse racing, while Boyd Gaming and Caesars host different events, shows, and other attractions. Now, taking how I actually look at these companies compare financially, Churchill Downs is forecasted to grow earnings and revenue by 17%, which is faster than the U.S. market, and 13.7% per year, while Caesars is only forecasted to grow earnings and revenue by 1.7% and 3.5% per year. And Boyd Gaming is actually forecasted to decrease earnings by 6.8% and increase by 1% per year, which means both of the other companies are forecasted to grow slower than the U.S. market, which is 7.8%, while Churchill Downs exceeds this number by almost double. Churchill Downs also has a significantly higher price to earnings ratio with 23.1, while Caesars is only 13.3 and Boyd is 8.2. This should reassure our investors as a higher PE ratio indicates higher earnings growth in the future. Churchill Downs also has a high basic EPS at 5.79, and this shows that we have a clear profitability in a per share basis compared to the negative 4.1 for Caesars Entertainment. And then compared to the hospitality industry as a whole, we have a low market volatility and growing earnings at an average annual rate of 30% compared to the hospitality industry, which is 18.8%. And I will swing it over to James with the future of our company.
Thank you, Matt. So for the future of Churchill Downs, we are looking, our ROE, which is our return on equity, is projected to be 52.8% in 3 years' time. That is higher than the industry average of 16.9%. That is very good. I hope the investors look at that because that will really show our investors that what the money that they're putting in, they're also getting out of it. Then we have our earnings are projected to grow 17% per year. The U.S. market is 14.3%. However, the earnings aren't really growing significantly each year. They're just going up. And for some closing remarks, I will swing it over to Jack.
Thank you for listening to this presentation. We hope this presentation was informative and helpful to you as an investor. We appreciate your continued investment in Churchill Downs, and we hope that you have a wonderful day.
Thank you.
Thank you.